All right. Well, it's wonderful to have you all here. Welcome to the one thing to care about in US payments. We'll be talking about the payments industry in the United States market today. My name is Lindsay Lear. I am the leader of PCMI, or Payments and Commerce Market Intelligence, and we're really excited about our event today. It's our first time really doing a deep dive into the US market. Most of you know us for having very deep expertise in Latin America and other emerging regions. And we really wanted to take this opportunity to provide visibility into what's happening into the US market. It's a very critical moment in history, new administration, a lot of noise out there in the media. We'll be covering a lot today that will help us all have some extra clarity and a fresh perspective on several of the things you may have been hearing. Now, why the one thing? For those of you who have followed us in the past, we tend to go very deep in our webinars, covering a lot of trends, bombarding you with data, and really providing a very rich and deep analysis, which is very valuable, right? However, this year we wanted to take a different approach where we're really giving you the one thing to focus on in key markets around the world. If you are going to prioritize one topic to pay attention to and to strategize around, this is our suggested development. Now, in Latin America, we cover 6 or 8 countries, and next week in Asia, we'll be covering about 8 different markets, the one thing in each market. The US is a bit different. It's one market, very large, very complex. So we've actually, what we'll be doing is diving into 6 specific topics and delivering one specific insight for each of those topics for you today. Okay, so if we go on to the next, just a very quick notice for you all, standard legal notice. And if we continue, I want to introduce my panelists joining me today. Again, my name is Lindsay Lear, based here in San Francisco. I'm joined by Danny Ayala, a senior consultant and partner with PCMI, who's very experienced in many of the topics we'll be talking about today. So I'm very pleased to have you, Danny. Welcome.
Thank you.
And Fernanda, welcome as well. Fernanda is a senior analyst with PCMI, joining us from Amsterdam. Welcome, Fernanda.
Thank you, Lynn. So for those of you who don't know me, I work here at PCMI. I've had experience in the payments industry for over 8 years now, working in different perspectives from fintechs, banks, and acquire. I'm Brazilian, but currently based in Amsterdam, and I'm here helping PCMI expand its business globally. So really excited for today's sessions.
Wonderful. All right, let's go ahead. Now, before we jump into today's content, I want to spend just a few minutes updating you all on developments at PCMI. Many of you have followed us over the years. Some of you may be brand new to us as a company, and I want to make sure you understand who you're learning from today, who you're engaging with. So if we go ahead, many of you knew us back in the day as AMI, America's Market Intelligence, right? Focused on Latin America. In 2022, we rebranded the company to reflect our global expansion. We focus on digital payments, and digital payments certainly does not stay within borders of one region, and we felt the need to expand. Now, this has been a very rapid maturation stage for us, and we had some wonderful successes in 2024, over 40 client engagements and 65% growth. Okay, so this global expansion has been very beneficial to us as we've been able to learn about all of these different trends. You can see the types of verticals that we work in and how heavy they are in terms of our demand from clients around the world. And if we go to the next slide, you all can see our global coverage. I'm so proud and honored to say that last year we conducted work in 51 global markets. You can see how comprehensive our coverage of the West is, right? North America and Latin America. Pretty comprehensive as Asia as well. And we're growing and continuing to focus in Europe and Africa. So this has been a deeply fulfilling and enriching experience, and we are hoping to just continue to get more knowledgeable around every niche and market that you all are focused on. On the next slide, a lot of you, you've been maybe attending our webinars, our coffee chats, reading our thought leadership, and being appreciated the value that we provide in our content. However, you may not fully understand what we do, what our actual business is. Essentially, at PCMI, what we are committed to doing is helping our clients make decisions, okay? They have to navigate a very complex environment that is changing at a faster rate every day. And many of our clients operate in over 180 markets around the world. And so what we attempt to do is deliver value in 8 different ways to our clients. And you can see how they're categorized here into 3 major service buckets. market intelligence, decision consulting, and change implementation. So just some examples, right? Through our research and through our field work, we help clients see clearly, see the competition, see the market trends, see what their users are demanding, see how regulation is changing. We help you gain influence through being more knowledgeable and having greater authority and ability to impact your clients, investors, and stakeholders. We help you supercharge your sales by helping you prioritize and go to market correctly. And then a level above that, we actually help you create simplified decision making, right? Sometimes these are very extremely important strategic and million-dollar decisions that you have to make. And we give you the insight that's really critical for you to feel very comfortable and confident doing that. And then we help you implement, right? From negotiating with partners, product development, RFP management, and general project management. We actually work as a extension of your team to help you implement and be successful in whatever endeavor that you're pursuing. Okay. We can go ahead. And just to bring this even more to life, these are some examples of successes that we actually did for clients. So, you may think of PCMI as a research firm, an insights firm, but no, we are decision and implementation and impact firm. These are some of the impacts we had for our clients last year, right? In a competitive benchmarking in payment acceptance, we convinced senior management to invest in specific product enhancements to compete better vis-a-vis their competition. Through a workshop of future payment strategy, we helped a client identify and decide on which value-added services they need to develop to be in line with futuristic trends in the industry. One of our biggest successes is in an acceptance market landscaping. We are actually, along with behind the client, able to impact local interchange rates. So these are big impacts that touch the client's network, and honestly, the industry at large. So hopefully this brings very much to life the value that we actually bring to our partners. If we go to the next slide. Now, many of you who may have worked with consultants and had a mediocre experience, some of these phrases may resonate with you. Just as important as what we do is what we do not do. And this is our commitment to our clients, right? My worst nightmare as a consultant is to deliver something that is just okay. That is just okay, it's pretty good, right? We want to truly over deliver in value to you. So we're never going to tell you what you already know. We're never going to be superficial, vague, or inauthentic. We are never going to overly depend on frameworks or consultant speak, probably the worst offender on this list. And we don't settle for good enough, right? We don't stop until we've added massive value to whatever operation you're running, whatever decision you need to make. Okay. And then if we go on. And then in further demonstrating this commitment to our clients, as we're growing, right, 65% growth in 1 year is very aggressive. We anticipate the same or even more this year. We need to get better, right? We work with the biggest clients, the best clients around the world. So we need to be the biggest and the best. And so we invested this year actually in a high performance coaching program, which is based on the largest research of high performers worldwide, studying the habits and principles of over 200,000 high performers in the world. This is the commitment that we have to our clients to deliver this level of excellence. And so whenever you're interacting with someone at PCMI, you can rest assured that we are basing our methods on tried and tested principles to deliver excellent results. Okay. So hopefully that gives you a good sense of who we are as a firm, how we engage with the industry and how we engage with clients. And I want to take a moment before we get into our content to just poll you guys. I'd love to hear from you so that we can better serve you. We can better deliver thought leadership for you. What are some of your top business needs right now? What is your most pressing business need, right? We have a lot of options here. Is it to empower your sales team, position your brand, become more persuasive with your clients? Is it simply to understand the complex environment that you're operating in? Is it mitigating risk? Make a high value decision? Maybe your challenge is actually internal and you have to convince internal stakeholders to follow your vision, right? Maybe you actually have made a decision, but you're having trouble implementing, right? Maybe you have to take definitive action on a recent decision. So which of these are most resonant with you right now as you face the challenges this year? This information helps us tweak and tune and really, connect to you at the highest level. All right. Give it just about 10 more seconds for everyone to answer. Seeing some great responses here. Okay, we can go ahead and close the poll. We'll just share that real quick so y'all can see, kind of interesting. So yeah, clearly understanding my competition risks and opportunities and being more persuasive with clients, right? Everyone needs to sell. So very interesting. Thank you, everyone. Okay, so with that, we will go ahead and move into the US market. And just before I do this, remember in the chat, we do have a Q&A down at the bottom. You have a Q&A icon. Please submit your questions and we will get to them at the end of the webinar. So please go ahead and feel free to interact with us with your question or comment. All right, so starting off, just giving us a little bit of context. Many of you, I know, I can see who's on the call here. Many of you work across emerging markets, right? And so the US is a totally different animal. So let's go ahead and look at what's going on in the US with respect to payment methods. When we consider the entire picture of consumer expenditure, all right, today in 2025, or by the end of 2024, 88% of this consumer expenditure was electronic. Doesn't necessarily mean digital, but it was electronic, meaning non-cash. Okay. And so when we think about payment volume, dollars, right, we have cash representing only 12%. Now, transactions, it's a little bit higher, right? Because cash is always a lower ticket. We see this massive chunk of money movement, which includes instant A2A, ACH, wire, all of those ways of account-to-account payments, wallet movement. And then we have cards. Now, the card market is absolutely massive in this market, $6 trillion in credit card volume. But comparative to traditional money movement, it's actually quite small. So when we look at how the US compares to Latin America, and next week we'll be doing the same exercise for Asia if you're curious. So make sure to keep your eyes open for that. You'll see this data for Asia as well. But you can see just how, Brazil is really Brazil and Chile are the only countries with similar levels of cash penetration in Latin America. Overall, the US, of course, is much more advanced, and cash has really been on the decline since the pandemic, just like in every market. But we can see at 12%, it's really almost a thing of the past, except in certain segments, which we will see in a moment. Okay, if we go on and we break this up into even smaller pieces, you can see credit and debit card here. You can see instant A2A representing 4%. What is it? What does that mean? That's Zelle, that's Venmo, that's consumer payments that are operating on FedNow. Real-time payments, still very small when we're thinking about consumer payments. Okay, we have cash, and then we have this gigantic traditional money movement. And you might think that seems very large. I don't think I spend 70% of my income on used by ACH or wire. However, this is the payment method for paying rent, for paying most of your utilities, for paying a lot of your insurance, for paying your mortgage. And when I sat down and did this on my personal expenses, I saw that it was actually very close to this specific breakdown. So as digital payments continue to evolve, there's this gigantic bucket of money, of money movement that is still slow, still manual, has not come up with any kind of agile and impactful user experience. So beyond cards, this is a giant bucket of spend to begin to think about disrupting. The other call out here is that instant A2A, which is very small, right, is actually not that far in share from debit card. Okay, so just a couple of years ago, this has grown rapidly in the past 2 years from less than 1% up to 4%, and is really not that different from debit card, which is an important call out in the US market, which is a true card dominant market. And this is going to continue to change based on the trends we're going to see in this presentation. Okay. Continuing on, just one more slide here is when we talk about cash, right? Cash is on the decline. And when we can see, according to the Federal Reserve, there's a lot of data out here about this. We see the cash as a share of payment transactions really on the decline over the past several years. But what's interesting is that when you look at the chart on the left, this bright red bar represents cash, and you can see how important it is to low-income families, right? Over 30% of household income is spent using cash for families who are making under $25,000. So there is an important financial inclusion story in the US. We don't always think about financial inclusion in this market, but it's a different type of conversation. It's not necessarily about access. It might be about usage. It might be about cost, but it's definitely something to consider that cash is still significant for a certain segment of the population. Okay. All right, so now we have a little bit of context under our belt, and we're going to go into talking about what's going on in this market that we want you to be paying attention to. And if we go ahead, I know that the Trump administration has been making a lot of big statements, making a lot of noise and taking a lot of action very quickly that has raised a lot of questions. Almost daily, I get questions from clients, what do you think the impact is going to be? What do you think the reaction from the market is going to be? So we certainly do not have the answers. So much of this is speculation. However, we're going to attempt to shine some light here. So the first topic that we're going into today is stablecoin and remittances. Okay, and this first portion really focuses on stablecoin and crypto. Okay, Trump's executive order made executive order actually banning CBDCs and banning any kind of work from the federal government on CBDCs. So here are actual quotes from the actual published executive order. The agencies are prohibited undertaking any action to establish, issue, or promote CBDCs. Okay. In lieu of that, there's actually some encouragement around and the creation of a working group on digital assets, right? Private market digital assets, crypto, and particularly stablecoin is called out in this executive order. And this is what the working group is called to do, right? Propose a governing framework, evaluate the potential, and hold public hearings to involve the wider market. Now, this is going into effect July 19th. And just based on experiences from other markets, specifically Brazil, when a working group such as this is if all goes according to plan, you can start to see some true market impact within 24 months. That's a speculative number based on past experiences. And the biggest thing that the market is expecting here is regulatory clarity around crypto and specifically stable coins. And you can see a quote from the chief strategy officer of Circle here, of course, who is the issuer of USDC. Really, the thought or the hypothesis here, some believe that this is really the start or the foundation of a truly free market and private market competition for digital assets, which is encouraging in some ways, right? And if we go to the next slide, I'm going to invite Danny to speak on this in just a moment. Regulatory certainty, what that could do is really unleash the power of stablecoin for banks, but more importantly, for other stakeholders who are going to move faster and who are going to potentially start competing with banks. So for everyone in this industry, it's time to really be paying attention and learning and developing a strategic plan for this type of asset, since the regulatory certainty should be coming in the next year to 2 years. So 3 major impacts: adoption by banks for wholesale and B2B payments, stablecoin for remittances by non-crypto natives, and then a surge in private issuance of stablecoin, right? And these are some examples that are already in the market. So Danny, welcome. First off, just tell us a little bit about your background. And I want to, you're very entrenched in this industry. So I'd love to hear your take on some of the things that we're speaking about.
Absolutely. Pleasure to be here with you and a pleasure to be working with PCMI on this effort as well as other efforts. I'm a veteran of banking and cross-border, 30 years experience, Wells Fargo, B of A, Chase, Bank of America, among others. And then the last 4 years, I've been working on fintech, supporting fintechs in the US, Latin America, and Asia, primarily on cross-border, both consumer and small business. So with that sort of exposure and engagement and experience, always having conversations with people in the industry and a couple of things on the CBDC side. America can do what it needs to do and what it wants to do, but the world's still, moving at its own pace on different topics. So to put things in perspective, in 2020, there were probably about only 35 countries around the world looking at CBDCs, primarily centered around Southeast Asia, as well as some parts of the emerging markets, if you still have such a thing in some places. Today, there's about 134 countries engaged in CBDC engagements, which represents about 98% of the global GDP. So regardless of whatever we do here, the world will probably continue to look at CBDCs. There's probably the country that's the furthest ahead as a point of reference is China, and following it close behind are India and Brazil. All pretty large economies looking at CBDC. So, the tide might turn in the future in terms of the U.S. perspective, and the ultimate end game of a stable coin is to be connected into a CBDC, right? So I think ultimately it's almost unavoidable. And for now, we're just probably a little bit less keen on using CBDCs because of the current administration's posture. So that's where that's at. In terms of stable coins, I think, stable coins been around for some time now, and there's been limited use and engagement until a few really innovative fintechs have come out and experimented with it. I think the key thing is there's three key things that you need to keep in mind is, this rulemaking that's going to happen in July, as you mentioned, needs to provide very clear rules around the custody of the coins, the values, the assets behind the coins, as well as the rules around the money movement in those coins. In this ecosystem with stable coins, you don't need a bank necessarily in the middle anymore, right? So you could have funds moving through stable coins very quickly across borders, and there is no bank involved until you do the off-ramp, on-ramp side. And that takes me to my last point, more associated to this slide, which is, while stable coins are much faster than the traditional clearing systems, and they are coined as being cheaper, they really completely eliminate or reduce the dependence on the old traditional correspondent banking networks that exist out there, as well as SWIFT-based type transfers. However, they still require on-off ramp because the real world still operates in fiat, right? And the payment systems of the world operate in fiat. And as a result of that, that on-off ramp has a cost implication, which is a surcharge on the payment that doesn't exist on the traditional world. The second thing is you do save money because your cost of compliance is much lower. And also your banking costs drop significantly. You gain speed because it's faster. But you have a big challenge on cross-border for stablecoins, and it's the level of engagement overseas. While a single country can move very quickly on stablecoin adoption, if you want to get Mexican pesos into a bank in Mexico, you need to find a way to get in there. None of the banks in Mexico are stablecoin enabled right now. So you need a party in the middle that does the on-off ramp, and that's where the slowdown could happen, as well as the cost associated with that. So it's really a question of it's kind of a trade-off, right? The on-off ramp cost versus, dealing with the speed and the challenges of the old school traditional banking ecosystem that exists today, and let alone, and we'll talk about this later, access to the banking system, which is a big obstacle in both sides.
Danny, I like what you said about a question I have is, you said there's kind of a new, like the on-ramp and the off-ramp produce fees, and these are fees that consumers may not be used to. So do you see companies, I don't know if it may even be too early to answer this question, but are those fees made transparent to the customer, or are they woven into a fee, right, that's not as transparent, right? Because a big trend in remittances is transparent fee structure. And if this is kind of almost a new way to make fees opaque, right? What are your comments there?
Yeah, I mean, the early experiments from about 3 or 4 years ago, I think even Facebook experimented with this with Guatemala, and that experiment lasted about 6 months before they exited. Did have those additional costs factored in, and it made it expensive. It wasn't cheaper than the alternative, right? I think what we are seeing is a shift where those are sort of built into the cost base. So when you are paying for the service, ultimately, it's going to be reflected in either the fees or the FX spread charge. Keep in mind, most of these on-off ramp costs are percentage-based, right? And the only thing that's percentage-based in remittances is the FX spread that you apply against the wholesale rate to make some money on the FX. And that's something that everybody does, and it's legal and all that sort of thing. So it adds incrementally to the cost of transactions. And those are some of the challenges that I think this business model has. It'll probably change because if everybody adopts stable coins, and for that matter, if we end up in a CBDC, then the concept of getting on or off ramp goes away, because then you're dealing with a local currency that is electronic, and you're just moving electronic mediums from one side to the other. So there is no on-off ramp. You're staying in those rails, right? But we're a long way from that.
Got it. Yeah. Understood. So I think, if we go to the next slide, the main thing here is that I think the industry, we can go ahead and show the phrase. The industry is really looking for certainty, right? As you said, these technologies have been around, they're not brand new. They've been around for several years now, but haven't scaled in large part. There's a lot of obstacles, but one of them is lack of regulatory certainty. So the potential for that is attractive to companies we've spoken to, or who are really looking at the US as a place to really start growing. And what that could do is, start to create truly an alternative to the established banking system through international rails. That creates new competition for banks, and of course, opportunity for banks to also incorporate that technology. We already see the biggest financial institutions doing lots of pilots and experimenting, but it's something to really start to be looking at, strategizing around, having conversations, developing partnerships, as this working group and the clarity starts to become more crystallized and concrete. Okay. So moving on, we'll speak a little bit more specifically about personal remittances, right? Stablecoin is a bit of a bigger topic related to all types of money movement. And we really want to talk about remittances here. Trump has also made some very aggressive statements and has already started to take action that is directly impacting immigrants in the United States. All right, so what has already been enacted? Okay, the suspension of asylum for undocumented immigrants. So we don't have a lot of big waves of people entering the country at the moment. Now this is going to impact, for the past, since 2020, remittances have grown 12% annually, which is about 3 times the rate prior in the 10 years prior to 2020. So the potential impact of that is certainly a flattening of growth, depending on how long that persists. And then proposed measures, some of which have already taken place, the deportation of undocumented immigrants, and then less likely to transpire, but also on the table, is a remittance tax. Okay, now the remittance tax in the narrative have been focused on remittances to Mexico because of just how large it is, and really Latin American immigration is being targeted just because of the size of it and the politics around the Mexico border. So this is what's on the table. And there's been a lot of questions. What impact is this going to have on the industry? To help put this in perspective and just put some numbers on the table, right? It's important to know that 24% of immigrants in the United States are undocumented. And of those undocumented immigrants, 70% are from Latin America. Okay, so we have a big immigrant community in the US, but about a quarter of them are undocumented, who are the ones to be impacted by these measures, and 70% of them are from Latin America. So it's very regionally sensitive. Okay, Danny, what are your just looking at these numbers and just you're very talk with industry players all the time. So what are some of the things you're hearing right out the gate?
Yeah, so first on deportations, I've been a very close study of that, just working with other people in the industry, and we've looked at these, and the deportations are impacting every nationality right now. It's a clear sweep. There are, deportation flights going to India. There are deportation flights going to Panama with Asian individuals that are needing to get transport onto Asia from Panama. So they're being held in Panama until they can arrange for transportation to their home country. So it's impacting everyone, I would say, with a higher impact on the larger segments, which is, Mexico and Latin America, as you point out. The perception of the market right now is in the very early stage of the sort of Thunderbolt deportation initiative. There was a bit of a quiet period that lasted about a week or two, as people avoided being on the streets, people who had questionable immigration status. So some of the cash-based players experienced strange patterns or less activity. At the same time, digital is going gangbusters right now. They're growing very nicely. They're seeing good trends across the board. I mean, I think Remitly just announced their earnings, and so did Intermex, or publicly traded companies. They're doing extremely well with their volumes and activity. So everything seems to be untouched. If anything, what I'm hearing is there's a spike going on. And the spike is immigrants in general, both documented and undocumented, feeling like this country is going to a period of instability for them and not having a bit of uncertainty. So moving some of their hard-earned savings away from the US and placing them in account back home in the event of something happening. And I think there's even people who are well documented and US citizens that are doing the same to diversify away from the US dollar. And we're seeing that, or we saw that a lot of that right after the election. So I think you see that. The other question that's coming up is, so what comes next, right? This is what's going on right now. What comes next? A shift to crypto as well, kind of a safe haven that you can access from anywhere in the world without having to worry about your whereabouts or access to the local banking system. There's typically a way to get crypto converted over to fiat in just about anywhere in the world. So I think that's definitely a shift. Some of the traditional digital players are starting to contemplate crypto more closely for two reasons. One, because of what I just described, but also because there's probably going to be more regulatory flexibility in being able to get there. So I think what's likely to happen, and then one last factor is that the most impacted immigrants are the ones that are recent arrivals, who are earning less, who are a little bit more concerned and desperate in the situation. But those folks are also sending less money because they've been here less years. They have less experience. So I would say the deportation is probably going to hit more the lower value remitters than the high value remitters. People like myself, I'm a US citizen, but I've been sending money home for 30 years. And I keep money overseas as well, because I feel that that's something that I need to do for my travel needs or whatever it might be. So that's likely to happen. I think what will happen is, once the dust settles, we'll probably see a slowdown or a leveling off of the growth. And then it'll be more a matter of what could happen. I think that, and I'm not making any kind of political statement here, but I think what will happen is this is kind of the showtime of deportations, right? We can't deport 11 million people. See, it's just a huge logistical nightmare.
Sending a message, right? The administrators just want it to be very impactful and very quickly, right? So
yeah, exactly.
Let's go to the next slide just to see kind of what you're saying visually, Danny. We have here we've done some scenario forecasting, right? In which we are assuming these are assumptions. This is modeling based on certain scenarios taking place, right? So we see 12% growth annually of remittances, from 2020 up until 2024. Now, as Danny said, this dark red line here is like a flattening of growth, going back to the standard 3 to 4% growth that we'd seen the 10 years prior, which is probably most likely. If 11 million people truly are deported from the US, we will see a little bit of a decline, but not that much of a decline because it's only a certain segment of people who send money. And to your point, they're probably lower value remitters. And then if there's a tax applied, that's what this dark green line. And now this is a complete speculation as to what impact that would have. We're just attempting to provide a visual of what these scenarios could look like in the medium term. But the most likely scenario is going to be this middle line here, which, as you said, kind of a flattening of the growth end, but still positive growth for the industry. So anything else you want to compliment here, Danny?
Yeah, no, I think this talks to what I was just saying. The only other observation is that possibly once this deportation stage happens, there'll probably be a normalization of the process and maybe even a way for the immigrants that are undocumented to have a path to being documented, right? For the ones that are productive and generating good output for the US. I think if that happens, we may see the growth coming back in. And, I don't think we'll see 4 years of deportations. I think we're going to see at most a year. And then something else will come about that will probably normalize the situation. So I would say that those are the key things. I think we'll see an increased level of adoption on digital wallets as a result of this. I think banks are still going to be very guarded with the undocumented as they have been in the past. At the same time, when the overdraft rules didn't apply for banks, they were aggressively going after the undocumented with the matricula cards. That might shift as a result, because if the overdraft rules go away, the lower income echelons of the economy generated billions of dollars of profits for the banking industry. Not going to speak to the ethics around that, but obviously that's gone with the overdraft rules. It might come back when those overdraft rules are overturned.
Got it. Okay. Well, very insightful. I think that helps people get a little bit of curbs the anxiety a little bit, just having a little bit of an expert kind of providing an opinion. So I think that's very useful. All right, let's go ahead. Our final statement here before we move on to the next section is, remittance volumes haven't changed yet. If anything, they've spiked out of kind of in reaction, right? The biggest impact long-term will probably be a shift towards digital and even crypto. So kind of keeping that in mind as our big statement around remittances. All right, so let's shift gears a bit. We're going away from cross-border payments and looking really at domestic payments. And what I think is fascinating about the U.S. market, right? This has been, I've grown up in payments studying emerging markets, while living in the U.S. So it's kind of been this interesting juxtaposition. So all of the trends we've seen in Brazil, in India, which were accelerated over the past several years, I personally am really starting to observe only in the last year in the US. We're talking about alternative payment methods, right? So this is a fascinating study that was done by the accounting firm Xero, showing the ways consumers want to pay versus payment methods offered by small businesses. And what we see is a very clear difference, right? Consumers want to pay with cards as their top #1 payment method. Only 70% of merchants, small merchants, are offering cards, right? A big difference, 90 versus 70. Jumping to online payment gateways and wallets like Venmo and PayPal, the reverse is true. Small merchants want to accept these, whereas consumers, there's less demand. And this is certainly fee related, right? Merchants want to accept these lower cost payment methods and they don't want to accept cards as readily. Same with bank transfers. Buy now, pay later, I find very interesting, right? There's greater demand from merchants, small merchants, to offer it than there is awareness, adoption by consumers. So there's kind of a mismatch there. The one that's a bit of a head scratcher is Apple Pay and Google Pay. Perhaps because Apple Pay and Google Pay is often integrated into a POS system. Whereas we're just, according to this survey, a little bit less demand from consumers. But the clear difference here is in cards versus Venmo, PayPal, Cash App, these other kind of P2P wallets that have really exploded around the world and are starting to catch on now. And what we're starting to see is really a mismatch between consumer and merchant preferences at the POS. Okay, if we go on. Surcharge, and this trend is directly related to small merchant surcharging. In the past year, I personally have started to witness surcharging for card transactions at a rate I had never seen before. Today, probably 30% of the small businesses I interact with are charging a convenience fee when you want to pay with a credit and sometimes even a debit card. This statement here, this was from a publication. This is quite alarming, right? From a restaurant owner in Portland, Maine, credit card fees are our third largest cost behind labor and food costs. We are spending over double our rent on credit card fees every month. That's a pretty big statement. And what's being made evident is that small merchants are lashing out or fighting back against swipe fees as other alternatives become available. So here we say, 34% of small businesses surcharge for credit card transactions in a survey that was done last year. 73% of consumers said that they would use credit cards less if they had to regularly pay surcharges. I can speak to this, at the nail salon, they they started surcharging for credit cards and they want you to pay with Venmo. The first couple times it's like, okay, it doesn't matter. I'll pay with my card. I'll pay the 3%. But every time you go and that happens for me, it's almost like a friction in myself. And I've actually transitioned to pay via Venmo. So they're teaching consumers a new behavior. And this could be quite dangerous as it continues for the card networks, as it continues and potentially accelerates. All right, let's go ahead. And this is directly related, of course, to inflation and kind of the tough economic environment that we've all been in the past several years. But a survey of small businesses really, said, what is your biggest concern or difficulty? And inflation by far is the biggest biggest trend or biggest factor impacting small businesses today. And so this is directly related, right? You look at your bank statement, you see all of your card fees, you think there are other alternatives out there, and we're actually seeing that materialize in the market. Danny, you spend your time between Miami and San Francisco. What's been your experience, your personal experience with this trend?
Yeah, absolutely with you on that. We talked about that offline before, but we're seeing this at an increasing level, especially in Florida. If you go around the higher end restaurants, they're adding a serving fee, which is something new. And when you ask about it, sometimes they tell you that it's because of the cost of processing payments generally. Others are directly charging and explicitly quoting a percentage when you pay with credit cards. And then if you look at the fact, a lot of condominiums now, condominium associations allow you to pay for the association fees with a credit card, and they tack on not only a percentage fee, but also a very high, hefty fee to the consumer trying to pay with a credit card. So definitely a rise across the board in both places, but I see it more prevalent in South Florida at this stage. If you're asking me to compare the two, I think in California there may be more consumer protection engagement and oversight than in Florida. I don't know, but that's just what I see.
Absolutely.
Yep.
Okay, and that's the merchant side, and on the consumer side, if we go ahead, I'd like to invite Fernanda to tell us about her research on the adoption of alternative non-card payment methods by younger generations, specifically Gen Z, who you can read about, ad nauseum about, their preference for buy now, pay later and other things. But Fernanda, tell us what you've learned by looking at this topic.
Yeah, sure. Yeah, it's difficult to talk about consumer behavior without going into the younger generation and how they are driving digital payments adoption, especially the Gen Z, especially because they are a generation who grew up with smartphones, social media, and instant everything. And also because Gen Z is not just the future anymore. Actually, they are a significant part of the workforce already. By this year, they're almost more than 25% globally. So their financial habits, they are not just trends anymore. They are really reshaping the payment landscape. And if we look at the data here, for example, if you take the P2P payments, which is Venmo and Zelle that you just mentioned, If we look at 2023, we already have a high rate of adoption, which we kind of keep the same level for today. But what really changed is how much people are relying on those platforms. If you look now, 40% of the Gen Z are already using Venmo and Zelle more than 5 times per month versus 25% 2 years ago. And that's the same for mobile wallets. Mobile wallets, we even have a higher adoption rate, but still, compared to 2 years ago, people are using more often. So that's the biggest shift. And if we look to buy now, pay later, which is even bigger, I guess, it's like a trend into this generation. In 2023, 26% of the Gen Z were using buy now, pay later in the last 3 months, while now it's almost half of the Gen Z population. So it jumped to 46%. So it kind of talks about that it's not just for buying expensive things or during holiday seasons, it's more about the everyday purchase. So it kind of gives us the perspective and the necessity of have instant and flexible payment methods.
Terrific. That's very clear. That's very illuminating, Fernanda. So if we go on to the next slide, what this shows us is we can show the statement there that banks and card networks have really seen the U.S. market as safe. Okay, and I know this from experience. However, this is changing. Consumers are developing new habits. Merchants are developing new habits. And what this might cause, growing tension, right, might mean a revamping of consumer incentives on card programs, right? Cards are still dominant. We saw 90% of consumers want to use a card. But the more merchants reject that or want to surcharge, that's going to break this incentive structure that's in place. And couple that with the adoption of alternative payment methods by certain segments of consumers, you have a complex environment that the industry needs to rethink around value proposition and incentives. Okay, so moving on, still on the topic of small businesses, this is a very hot topic. A lot of clients are asking about small businesses and their digitization. And digitization, of course, leads to adoption of digital payment methods and financial services. I want to ask Fernanda to take us through this section, specifically talking about AI and the use of tech platforms overall.
Yeah, sure. Yeah, so by now, at this point, tech use by SME is pretty universal. We have here like 99% of SMEs use some kind of tech platforms, and 80% are now using SaaS platforms to run their business. And if we look at this chart here, we can see that it's pretty widespread. So SMBs, they are using a mix of different tools, from accounting software to market platforms. But what really stands out is the rise of AI. So from 2022 to 2024, it nearly doubled the adoption, positioning itself as the 5th most used technology among SMBs. So if we go forward, yeah. Okay, so why is that important? So in general, SMBs using companies, it helps them grow, it helps them be more successful, and also helps payment companies have a digital environment to embed payments. If we look at this first chart here, we can see that still the large group is the low adopters, which are SMBs who doesn't rely in more than one tech platform. However, if we look at the high and very high, we can already see that it encompasses nearly half of US small business. It's about 47%. And if we look at the last column, which is the very high, we can see that that's the fastest growing group. So which means that the learning curve is getting steeper, meaning that there are more and more platforms out there, which kind of adds some complexities for SMBs. But what is important, it's seeing the positive results. Like if we look at the other chart, we can see that SMBs who rely in more platforms, they tend to experience high sales and profit growth. So the connection between tech use and success is getting really strong, and that's a potential like this environment, this digitization of SMBs, they are a potential place to embed payments. So if we go next. So talking about AI specific, what we can see is that SMB's competitiveness will soon depend on their ability to integrate AI solutions. So we know that now a lot of companies are already incorporate some basic tools for marketing purpose, ChatGPT, or even consumer service. But what we can see is that more and more companies are adopting more advanced platforms to deal with more complex issues, such as finance, accounting, and automation. And what really makes you think is that before AI, only large corporates could have access to these advanced automations and predicted analytics. But now with AI, even a small business with limited budget can have access to these AI tools to handle these complexities and challenges. So they are becoming more competitive. And at the end, the SMBs, they're not just adopting technology, they're just using in more sophisticated ways to boost efficiency, drive growth, and AI is in the center of that shift. So can you pass one slide? So our one thing here to think about it is actually we can see two opportunities with different perspectives, actually. The first one is that AI platforms can embed payments. So we know that payments are digital first and a core necessity for SMBs. So AI-powered platforms, whether it's marketing, consumer service, business operation, they can actually integrate payments as part of their ecosystem. So, but for a different perspective, AI-driven business management tools can become a value added for acquirers and PSP. And this really talks about these high fees that we just talked about. We know that high fees are a pain point for many small business. So instead of just competing in price, payment providers could offer AI-powered business tools as a value-added service. In that way, they can actually help small business to be more efficient and competitive while also differentiating themselves in the market.
Terrific, Fer. Thank you very much for that. Always, getting an update on AI and how it's impacting the industry is important. And, I love that quote that, said, AI is basically enabling small businesses to access enterprise level efficiencies. So we can expect this sector to be a really important niche for operators going forward. Okay, and related on that note, this is a little bit related. If we go ahead, we're going to talk about a major trend is embedded finance. All right, embedded finance scaling for both consumers and small businesses. Both of these customer groups wanting to see payments closer to them and embedded in how they operate. And embedded finance, this first slide just shows how far beyond buy now, pay later embedded finance goes, right? So POS, point of sale lending, is a wider umbrella term. We see all the buy now, pay later guys who are well known. We see banks moving in to point of sale lending and trying to create their own buy now, pay later product. And of course, we see industries far beyond retail embracing financing, beyond the scope of a bank, right? So home improvement, auto services, healthcare, weddings. These are travel. These are industries that are very prone to lending already because a high percentage of that expenditure is financed. And so this finance function is starting to be embedded and disrupted through innovative models. So if we go to the next slide, can show you how this works a little bit, right? A typical buy now, pay later flow, you have the buy now, pay later fintech integrating with the merchant and providing services to the end consumer, right? In other industries such as travel or or automotive or home renovation, when you have a small business embedded in that flow, such as a contractor or a travel agency or an auto mechanic shop, you now have a little bit more of a complex flow. And this is what's really starting to take off. Because of the technology required, it's been a little bit slower than consumer-based point of sale lending, right? In SMB lending, you actually have the lender, you have a PSP involved, you have a SaaS platform involved, then you have the small business like the contractor, right, who then is going to interact with the end consumer. And so we actually have two opportunities here. The home improvement contractor giving a loan to the end consumer, empowered by all of these tech and finance partners behind it, or the small business itself is receiving the loan. So we actually have two it splits right there to provide two different business opportunities. We continue. And then we'll, verticalize SMB finance. This is actually the results of a study done by Adyen, which was great. Very focused on embedded finance for small businesses. And this just shows how the opportunity size for embedded finance, verticalized SMB embedded finance, the existing revenue opportunity versus what's actually being captured by market players. And you can see these green numbers here are the potential market to capture. Okay, so this is an emerging market. This is something that is in its infancy, enabled only by a handful of players. We see banks and other fintechs entering this market more aggressively, and is certainly something to be looking at. We have some data points here. SMBs, 40% are interested in financial services from their tech platform. So still a lot of awareness there, but 40% is a very decent number that certain niche players are starting to take advantage of. And if we go on to the next. What is interesting about this market as well is that embedded finance, especially for small businesses, allow platforms such as Toast, Shopify, Lightspeed, these SaaS platforms that serve small businesses. It allows them to actually turn into fintechs and drive massive new revenue. So in these examples, you've got 60, 80, 80% of their revenue is actually coming from financial technology, not the original platform that they went into business for, but the financial services that they're offering through that platform. And this is the playbook of PayPal, right? That spun off from eBay. Mercado Pago, we see this in Latin America. Over 40% of Mercado Libre's revenue actually comes from Mercado Pago, and Alipay spinning off from AliExpress. Not to say that these guys are going to spin off their own payment companies, but Toast, for example, is already a very direct and formidable competitor of Square, which is a horizontal play, whereas Toast is very verticalized, specific in small business industry, which is restaurants, right? So this verticalized SaaS embedded finance is something that we're seeing have really fantastic results and ramp up as small businesses become more digitized. As Fernanda told us, we really see that as an accelerating trend. All right. So moving on, our final statement here, if we take a look, is that this is the newest vertical that FIs and payment processors must target if you want to access consumers and small businesses, right? Traditional way of doing business is on the decline a little bit, and ramping up very quickly is delivering financial services through technology partners and through other channels. All right. Now we're almost out of time, but we do have one more trend here that I do want to spend some time on. If we go into what we're seeing on this last trend is the difficulty that fintechs are facing in accessing the banking system due to regulation and various factors. So I'm going to have Danny speak to this. We have three big statements here on the left. Danny, you're really an expert on this, helping fintechs and others access the banking system. So tell us a little bit, what are you seeing in the current regulatory environment? Oh, you're on mute, Danny.
Sorry. Absolutely. Fintech and money transfer businesses, and as well as any business that's cash intensive, although the three are not completely 100% related to each other, have historically struggled in getting banks to desire to bank them. That's the first obstacle. So it's almost a barrier to entry. Then there is the second challenge for fintechs operating in the space, which is holding on to that bank, whether that bank changes its appetite for risk and compliance exposure and oversight, and decides to provide a exit letter, typically 30 days, where these companies have to sort of search an alternative very quickly. It's no secret that some of the big names out there, including Wise, have gone through bank changes to the tune of 3 banks in 1 year because of these challenges they face, not because they're doing anything wrong, but because the risk appetite changes or their business model is no longer fitting for the bank. And then the third challenge is banks just not being interested in participating in the space. So those are the 3 obstacles you face. Currently, there is a significant bottleneck in just being able to find a bank that will support fintech type use cases, especially when there is either a cash element or a cross-border element involved. So, some of the strongest banks in the space, like Cross River Bank and CFSB, are 2 banks that are doing very little in the space. And I think they're giving way, that challenge is giving way to a higher level of engagement and interest in looking at stablecoin type opportunities where you just don't really need a bank to do the effort on the back end, but you ultimately will need a bank somewhere to capture that fiat. So to a lesser extent is an issue. Second part of that is obviously the having access to the licensing if you're going to move money cross-border for consumers and being in compliance. So it's tough. Bank costs are extremely high for this, it used to be that if you were a significant fintech and you had 1 bank, you're okay. My advice to fintechs right now is let's go find 2 banks and have them participate, and let's start looking for the third one once you get the second one and running, because things are changing very quickly. So it's a bottleneck. You may talk about the articles that have been written recently since the new administration came on board, where there clearly is some criticism towards the banking industry around the fact that they are closing accounts or not providing access to the banking system, and some of these folks end up being either out of business or being unable to serve a market that's needed, and that's what gives rise to people wanting to use crypto and other things that are not as traditional.
That's fascinating, actually. What is considered in many ways to be a very open market is actually difficult to operate in. And we haven't seen like a fintech revolution in the US like we have in other markets. It's very interesting that you're saying this is kind of potentially pushing folks towards crypto, which is probably not the intention, but a very interesting implication.
Yeah, and I think there are some good actors. I mean, not all banks are avoiding these. There are some really good names out there that are engaged and positioning themselves with that. I work with some of those actors. I think I mentioned this to you, but I have a roster of about 62 banks that do something in fintech. And of those banks, right now, there's probably 5 that are actively engaged with new partners. Everybody else is either not responding to the emails, to the phone calls, or explicitly exiting or explicitly holding. It's not unusual for a bank that's engaged in the industry to tell you, we're bottlenecked right now, so we're not taking any new clients until the end of 2025 or until the middle of 2025. Or, how much money has this fintech raised? If they raise less than 50 million or less than 100 million, I'm not interested, because my supply of project management is very limited and there's enough demand for it. So there is a significant bottleneck. I think and this is a global issue in general. The only country that's really made headway and created a lot of avenues to make fintech happen, and they are yielding the results of this in the world that I see, is absolutely Singapore. That's
100%. And you can see that just at the Singapore FinTech Festival, just how much collaboration there is. You can definitely see that.
Yeah. So hopefully that will change. I think banks are, sort of conditioned to being scared. Maybe the conditioning will change and the market would open more widely, so we can, lead the world in this space and category.
Yeah, 100%, 100%. Okay, well, thank you very much for that. Let's go ahead. All right. So I want to that kind of wraps up our major 6 topics that and our 6 one things we wanted to deliver to you guys today. And I want to 2 things before we go. We're actually going to leave the Q&A to follow up offline since we are a couple minutes over time. But a couple of things just before we wrap up. I want to make sure you're all aware of our next week, our Asia Pacific webinar that we're having next week. Same framework, but focus on Asia, which is a fascinating market. And you'll hear from our Asia-based team over there. For those of you who want to rejoin our coffee chat series, many of you have been following us for many years. We're actually doing it on a new time this year, kicking off Wednesday, March 19th at 12:30. And of course, you have the Latin America webinar, which is up on our YouTube channel if you want to see that. So while you guys take a look at those QR codes, I want to just, as we say thank you for attending, launch our final poll. I'm curious, from this data, depending on what your business is and how these trends are impacting you, we would really like to know, how would you like to engage with us, right? Do you have a specific project in mind that you think we could potentially add value to? Do you like what you heard, but you're not sure how you want to work with us? We'd love to just get to know you and understand your business and see if there's any type of connection. Maybe now is not the right time, but you'd like us to reach out next quarter. Just please take a moment to let us know how we can interact, how we can be in touch. If you want to share your thoughts on the webinar, if you want to share your perspective on any of these trends, just give us a notice there in the poll, and we'll give it just a few more seconds, give a chance for everyone to respond. And hopefully, as we're waiting, you guys can take advantage of these QR codes and we can see you next week. Notice that our Asia webinar is on Tuesday evening for those of you based in the West, and it'll be in the morning Singapore time on Wednesday, March 11th. So just take a couple more seconds and we will close out. We can go ahead and close that. All right. And if we just go to our final slide, I just want to reiterate how much we can just go one more. We really are committed. Hopefully you could see that through the depth and richness and, analysis of these trends. We're really committed to your success. We love what we do. We love this industry. I know Danny has the same, doing this for 30 years, very, very deeply passionate about these topics. We love to see clients succeed. So, wanted to leave that with you as we close out today. Thank you very much for joining us, and we look forward to interacting with you very soon. All right, take care, everyone. Thank you so much.